Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is November 13th, 2025. And we're going to talk about safety and returns in this volatile market. You can note on this left-hand side that we have a lot of sell-off today. We have some bearishness, the broad market selling off. The stocks, especially technology stocks, as you can see, are down 2.7% or more. Some stocks being down over 5% for the day. So when we're seeing all that sell-off, I'll have you note up here at the top, crude, consumer staples, energy, and healthcare are actually doing well. We're seeing flights to safety. We're looking for safety measures in the midst of all this. I do still like utilities in the middle of this, but today we're going to specifically talk about consumer staples, healthcare, and energy, and very specifically, staples and energy. So what I'm looking for in today's move is looking for stocks that offer a dividend that are going to give us a little bit extra safety net in the middle of this chaos, in the middle of this noise, in the middle of this sell-off. If the technology is not going to prop it up, consumer discretionary is down 2.3%, consumer or technology is down 2.7%, we want to be looking for safety if we're going to try to hold these for a longer time period. And I believe you're going to see investors long-term propping up and holding on to those that offer dividends in the defensive areas. So to do this, what I'm going to do is search for those in my scanner and start with some basic concepts of just looking for optionable stocks that have tight spreads in the bid and the ask price, as well as a good dividend. So what I've done here is I've made sure stocks are between $25 and $600. I don't generally want stuff under $25 or definitely not below $15. I don't think the options trade very well there. Volume, we want to have $500,000, really $1 million or more. And I'm not too concerned about the front vol, but we're going to go to yield. We're added yield in here that we're getting at least a 1% dividend yield. Even if it just sits there flat, we want to get paid something. We're going to look for those with higher dividends. But in running the scan across the entire market, you can see there's about 126 stocks that meet these conditions. We can turn that up to 2% yield, and it'll take out a little bit. And we're at 91. And now we're going to have it intersect with these particular sectors. So the first one we're going to do is go down to by industry. We're going to go to energy, since that is the one we were watching today in the main room. And we're going to select all energy. I'm going to hit the scan, and you're going to see there are 17 stocks that have a dividend of over 2%, that have a good spread between the bid and the ask price, good option premium, and give us opportunity. We've already talked about ConocoPhillips. We've already talked about Phillips 66, but we have others to look at too. And we're going to focus on ExxonMobil, EOG, and CVX, just these top few. So if we're looking at these, let's go into this. Let's look at the chart. XOM, EOG, and CVX. XOM is our first one. And as you can see, we broke out through the highs, pulled back, and it's a nice little bounce. There is a dividend coming up. So if you wanted to own the stock and get that dividend, we can already be involved. We could buy XOM, buy the stock, and collect that dividend. Or we could sell puts against it and be willing to buy it, but just understand that to get that dividend of $1 on ExxonMobil, which is almost 1% in the next week, we need to own the stock XOM. Even though EOG has sold off quite a bit this year, I like the fact that we've bounced off of the previous support level, turned back up, are creating higher highs and higher lows. And they do have a dividend, but we're already past it, so we're not going to collect that dividend again, likely till the end of January. So this one will allow us to collect about a 3 to 4% dividend if we hold it for the long term, but we're also deeply discounted at these lows. So here, I would go to the options, and I'd look down at the bottom and see, are we going to get paid a lot for selling these? The answer is no. It would tell you just buy the call or buy the stock. Buy the stock to get that 3.7%. Or buy the call since it's super cheap at 15 percentile for the year. And while we're here, we will now look at CVX. So Chevron Corporation, 4.4% yield. While we're uncertain, great place to go looking for returns is in the yield. CVX also a low percentile. So if you're chasing the dividend, which is coming up next week, you buy the stock. If you're not chasing the dividend, but chasing the potential rise in the price, you could buy the call, and the calls are relatively inexpensive as it's in the bottom 15 percentile. And we'd look at the calls probably in December, January, February for a stock like CVX. And there are dozens, as we already showed you, there are dozens, there's 17 specifically in energy that are going to pay you a dividend of more than 2%, that have good debt structure, and are giving you bounces and breakouts in the energy sector. So I like pretty much all of these. They're all reasonable as a consideration to add energy sectors to our portfolio. Now, if we look at consumer staples and healthcare, we're going to change the intersects with energy and change that by industry to consumer staples. And we're going to select all consumer staples. We're going to leave it at that 2%. And we're going to run the scan here. So we had 17, and now we have an additional 10. Now we're at 27 stocks that are worth considering. And if you look, all their fixed coverage charge are showing us that they have enough money to make it through the year and pay for all their core expenses. Now, all of these are also going to have a lot of inventory. It's the reason why their quick ratios are sub 1, but that's okay. These are high dividend stocks or dividend stocks that are in the consumer staples sector. Let's start with the top one again. Let's do PG, PEP, and Target. Starting with PG, before we even go look at the chart, they're a 2.8% dividend yield, not super high, but a reasonable yield, a reasonable return. And if we looked at their implied volatility rank, it's relatively low. If we look down here, it's 28%. So we're not chasing the dividend because that's not going to come out again until next year, late January. So we could just buy the calls. The calls are relatively inexpensive. We could buy out for December 19th. We could buy a call and sell premium against it. And buying the delta near 70, like I like to do, would be the 140 or the 145. We could buy the 140 and sell the 150, collecting a net positive $1.50 of time decay. And Procter & Gamble, since we're not chasing that dividend, we would just plan on it going up. It cost us about $6.50 to make a $10 trade. So it's about 50% return on risk, but we're already above break even. As long as it doesn't go down more than $1 or $2, then we're fine. If we look at the chart, we can see we did bounce off the lows. I'm not super convinced with this pause here, but as long as we can stay above 147, I do think PG looks fairly promising. While we're on the chart, we'll go to Pepsi. Pepsi, as you can see, has made a higher low, bounced off the lows. I like this as a short-term entry or timing on this. But let's go look at the options. Let's look at the stock. We know that the dividend was paid all the way back here in September, which means the next one is coming up. So if we go to the trade tab and look at Pepsi, ex-dividend date was 9/5. We haven't declared it, but likely sometime in December. We may want to just buy Pepsi. So we could collect that dividend, 3.9%, so about 1% per quarter at the current price. If we scroll down to the bottom, fairly inexpensive options, 22%. And that's where we'd kind of set up for that next trade. If you said, well, I'd be willing to own it here, they will pay you 3% for just over a month. You could sell the 145 at the money and collect $4 to $4.40 and lower your cost basis to 141 and get assigned the stock. You probably could do that and get assigned and collect the dividend. It just depends on the timing and when they do the ex-dividend date. The last one we're looking at here on consumer staples is Target, TGT. And let's start with the options. Scrolling down to the bottom. 64% implied volatility. Lots of premium to be had here. And if we own the stock, they're going to pay us a 5% yield, the top yield of all the ones we've looked at so far. Now, if we look at the dividend, that dividend was 11.12, so it just got paid out. We're not going to chase that because it's 3 months away. That tells us let's collect as much premium as we can between now and the next ex-dividend date. Without even looking at the chart, you can get paid 5.9% for your willingness to own it at 90 when it's trading at 90.75. So instead of buying the stock outright, you could sell this 90 and have a cost basis of 85. Then if you do get assigned and collect the dividend later, you're ahead of the game by about 6%. The last thing we're going to do is go to intersects with, change that one more time to healthcare. And run the scan here. Same thing, we're looking for dividend yielding stocks in those sectors. Now healthcare, you see Johnson & Johnson, Merck, Glaxo, Gilead, Medtronic, and AbbVie. We're going to start at the top, the ones that have the best fixed coverage charge, and look at Johnson & Johnson and Merck. Johnson & Johnson has a 2.67% yield. The dividend is upcoming on 11/25, so as long as we own the stock before 11/25, we will get that $1.30 dividend. And when we're this close to it, you could end up buying the stock and letting the dividend pay for the protective put in case something crazy happens between now and 11:25. So we could buy out to 11:28 and use that dividend here to pay for our safety net at about maybe the 190. Now, I'd prefer to wait till we're a little closer to do that, see if we can get them to match. If it's right the week before, you should be able to do an at-the-money put for roughly that dividend cost. But right now, you could buy the stock, get the 2.67%. The options are a 26 percentile, so they're relatively inexpensive, and we'd probably be buying calls if we weren't chasing the dividend. The last one we're going to look at is Merck. Now, GSK, or GlaxoSmithKline, is almost identical. It's 3.5% dividend yield on a stock that has almost identical implied volatility. So the two look very similar. I'm going to focus on Merck. They have weekly options and a little bit better spreads here. So if we look down at the bottom, you can see that the cost associated with MRK, you can see, is a 25 percentile. So this would tell us generally that we want to buy calls. But at this point, if we want that 3.5% dividend yield, and we know that the ex-dividend date's coming up probably mid-December, we probably just want to buy the stock. If we want to buy the stock, but we want to buy it cheaper, we could still try to sell December 19th. I'm not sure when the ex-dividend date is going to happen. So if we can get assigned by the time they do the ex-dividend date, which means if we sold the December 19th and the ex-dividend dates after that, then we could get assigned at 90. They will pay us 2.5% roughly. That means that if we're getting paid 210 to 220, and the stock price has to fall to 60 to get us assigned, that means we're getting paid 2.5% for about a month. Our safety net on it, this is 5%. And so we could collect 2.5% while we wait to get assigned. And if it does go up, well, we get 2.5%. If it doesn't go up and stays where it's at, we get 2.5%. If it goes down, we get 2.5% and get assigned and have a discounted price of about 5%. That's great. We can do that. However, if we want that dividend and we look at the chart, we can see we got higher highs, higher lows, and a breakout. I think Merck could go all the way up to 100, 102 in the next coming weeks. And so if I can get that directional move of nearly 10% and get a dividend payment sometime in December, this might be a better play just to own the stock. And I do think this is what we're going to see across the board. You're going to see more conservative yield returning, or where we're looking for dividends as returns in safe sectors. I do think that's what we're going to see ongoing. I don't see this as the next run up, the next bull market. I see this as a time to see flight to safety, defensive sectors, and dividend seeking. And I think that's going to go on for weeks, months, and possibly the next couple of quarters. And that's what I will be looking at in our main session every week. Thank you for watching, though, and we'll talk to you again next week.